Welcome to our channel. If you've ever wondered how financial markets work and how you can start navigating them with confidence, you're in the right place. Today, we're going to explore the exciting world of financial markets, providing valuable tips and insights to help you understand and navigate this complex universe. Be prepared to learn and expand your financial horizons. Let's get started. But before we dive in, don't forget to like the video, leave your comment, and subscribe to the channel to stay always updated. Thank you. 1. Introduction to financial markets. Financial markets are venues where individuals and institutions buy and sell financial assets such as stocks, bonds, currencies, commodities, derivatives, and more. They play a vital role in the economy by allocating resources, providing liquidity, reducing risks, and facilitating trade. Financial markets can be classified into different types based on the characteristics of the traded assets, contract maturity, level of regulation, and the degree of information available to participants. In this section, we will explore some of the key types of financial markets and how they operate. We will also discuss some of the benefits and challenges of financial markets, as well as some of the recent trends and developments affecting them. Some of the key types of financial markets include 1. Money markets. These are markets for short-term debt instruments such as treasury bills, commercial paper, certificates of deposit, and repurchase agreements. Money markets provide a source of short-term funding and liquidity for governments, banks, corporations, and other financial institutions. Money markets are typically over-the-counter (OTC) markets, meaning that transactions are conducted directly between buyers and sellers without a centralized exchange or clearinghouse. Money markets are usually very liquid and have low credit risk, but they also offer low returns. 2. Capital markets. These are markets for long-term debt and equity instruments such as bonds, stocks, and preferred stocks. Capital markets provide a source of long-term funding and investment for governments, corporations, and individuals. Capital markets can be primary or secondary. Primary markets are where new securities are issued and sold to investors, while secondary markets are where existing securities are traded among investors. Capital markets can be traded on exchanges or OTC, depending on the type and size of the securities. Capital markets are generally less liquid and have higher credit risk than money markets, but they also offer higher returns and more diversification opportunities. 3. Foreign exchange markets. These are markets for trading currencies such as the US dollar, euro, yen, and pound. Foreign exchange markets facilitate international trade and investment, as well as hedging and speculation. Foreign exchange markets are OTC markets, where transactions are conducted through a network of banks, brokers, dealers, and other intermediaries. Foreign exchange markets are the largest and most liquid financial markets in the world, with an average daily turnover of over $6 trillion. Foreign exchange markets are also highly volatile and influenced by various economic, political, and social factors. 4. Commodity markets. These are markets for trading physical or virtual commodities such as gold, oil, wheat, and Bitcoin. Commodity markets serve as a platform for price discovery, risk management, and physical delivery of commodities. Commodity markets can be spot or futures markets. Spot markets are where commodities are traded for immediate delivery, while futures markets are where commodities are traded for delivery on a specified future date and price. Commodity markets can be traded on exchanges or OTC, depending on the type and standardization of commodities. Commodity markets are often subject to supply and demand shocks, as well as speculation and manipulation. 2. Types of financial markets. Financial markets serve as platforms where buyers and sellers engage in the trade of various assets such as stocks, bonds, currencies, commodities, derivatives, and more. These markets play a crucial role in the economy by facilitating resource allocation, risk transfer, price determination, and wealth creation. Based on the characteristics of the traded assets, contract maturity, level of regulation, and information availability to participants, financial markets can be categorized into different types. In this section, we'll delve into some of the primary types of financial markets and their operations. Some of the most common types of financial markets include: 1. Stock markets. Stock markets are where publicly traded company shares are bought and sold. They allow investors to trade stocks, which represent ownership stakes in companies and provide a platform for companies to raise capital from the public by issuing new shares or selling existing ones. Stock markets are typically regulated by authorities like the Securities and Exchange Commission (SEC) in the U.S., aimed at protecting investors and ensuring fair and transparent trading. Some of the world's largest and most influential stock markets include the New York Stock Exchange (NYSE), Nasdaq, Tokyo Stock Exchange (TSE), and London Stock Exchange (LSE). 2. Bond markets. Bond markets are where debt securities such as government bonds, corporate bonds, municipal bonds, and mortgage-backed securities are traded. Bond markets enable borrowers to raise funds from creditors by issuing bonds, which are contracts promising to pay a fixed or variable interest rate and repay the principal amount on a specified date. Bond markets also allow investors to lend money to borrowers and earn interest income, as well as diversify their portfolios and hedge against inflation and interest rate risk. Bond markets are often segmented into primary markets, where new bonds are issued, and secondary markets, where existing bonds are traded. While bond markets are generally less regulated than stock markets, they are still subject to some oversight by agencies like the Federal Reserve in the U.S., which can influence bond supply and demand through its monetary policy. Some of the most active and liquid bond markets in the world include the U.S. Treasury market, Eurobond market, and Japanese government bond market. 3. Foreign exchange markets. Foreign exchange markets are where currencies from different countries are traded. These markets allow participants to exchange one currency for another, whether for international trade, investment, tourism, or speculation. Foreign exchange markets also determine exchange rates, which are the prices of one currency in terms of another. Forex markets are decentralized and operate 24 hours a day, with major trading centers in London, New York, Tokyo, and Singapore. While largely unregulated, Forex markets are influenced by factors such as central bank interventions, interest rate differentials, trade balances, and political and economic events. Some of the most traded and volatile currencies in the world include the US dollar, euro, Japanese yen, and British pound. 4. Commodity markets. Commodity markets are where physical or virtual commodities such as agricultural products, metals, energy, and gemstones are traded. These markets allow commodity producers and consumers to hedge against price fluctuations, as well as enable speculators to profit from price movements. Commodity markets can be divided into spot markets, where commodities are traded for immediate delivery, and futures markets, where commodities are traded for future delivery at a predetermined price and date. Commodity markets are often regulated by bodies like the Commodity Futures Trading Commission (CFTC) in the U.S., aimed at preventing market manipulation and fraud. Some of the most important and widely traded commodities in the world include oil, gold, wheat, and coffee. 3. Understanding market participants. One of the crucial aspects of financial markets is understanding who the market participants are and what their roles, motivations, and strategies entail. Market participants are individuals or entities directly or indirectly involved in trading in financial markets. They can be classified into different categories based on their objectives, functions, and behaviors. In this section, we'll explore some of the key types of market participants and how they interact with each other in the dynamic and complex market environment. We'll also discuss some of the challenges and opportunities they face. Some of the primary types of market participants include: 1. Investors. Investors are market participants who buy and hold financial assets for the long term, typically over a year. They aim to generate income from dividends, interest, or capital appreciation. Investors can be individuals or institutions such as mutual funds, pension funds, insurance companies, or sovereign wealth funds. Investors typically have a low risk tolerance and a diversified portfolio of assets. They rely on fundamental analysis, which assesses the intrinsic value of an asset based on its financial performance, growth potential, competitive advantage, and other factors. Examples of investors include Warren Buffett, known for his value investing strategy, and BlackRock, the world's largest asset manager. 2. Traders. Traders are market participants who buy and sell financial assets for the short term, typically less than a year. Their goal is to profit from price fluctuations and market trends. Traders can be individuals or institutions such as hedge funds, proprietary trading firms, or market makers. Traders typically have a high risk tolerance and a concentrated portfolio of assets. They rely on technical analysis, which uses historical price patterns, indicators, and signals to predict future price movements. Examples of traders include George Soros, famous for his bet against the British pound in 1992, and Citadel, one of the world's most successful hedge funds. 3. Speculators. Speculators are market participants who take high-risk positions in financial markets, often using leverage, derivatives, or short selling. They aim to exploit market inefficiencies, anomalies, or mispricings. Speculators can be individuals or institutions such as arbitrageurs, activist investors, or distressed debt investors. Speculators typically have a very high risk tolerance and a highly leveraged portfolio of assets. They rely on market intelligence, research, and analysis to identify and exploit market opportunities. Examples of speculators include John Paulson, who made a fortune betting against the subprime mortgage market in 2007, and Carl Icahn, known for his activist investing style. 4. Market makers. Market makers are market participants who provide liquidity and price discovery to financial markets by quoting bid and ask prices for a given volume of an asset. They aim to profit from the bid-ask spread, which is the difference between the price at which they buy and sell an asset. Market makers can be individuals or institutions such as banks, brokers, or exchanges. Market makers typically have a neutral exposure to risk and a balanced portfolio of assets. They rely on market data, algorithms, and models to adjust their prices and volumes according to market conditions. Examples of market makers include Goldman Sachs, one of the leading market makers in global financial markets, and Nasdaq, the largest electronic exchange in the world. 1. Bonds. Bonds are debt instruments that represent a loan from the holder to the issuer. They promise to pay a fixed or variable interest rate, coupon, and repay the principal amount, face value, on a specified date, maturity. Issued by governments, companies, or other entities, bonds can have different characteristics such as redeemable, convertible, or zero coupon. While considered less risky than stocks, bonds are also subject to risks such as interest rate risk, credit risk, and inflation risk. 2. Stocks. Stocks represent ownership in a company and confer rights to shareholders over the profits, assets, and decisions of the corporation. Issued by public or private companies, stocks can be traded on stock exchanges or over-the-counter markets. There are different types of stocks such as common, preferred, or treasury stocks. While considered riskier than bonds, stocks offer higher potential returns, subject to risks such as market risk, company risk, and dividend risk. 3. Derivatives. Derivatives are contracts whose value derives from the performance of an underlying asset, index, or event. They are used for risk hedging, speculation on price movements, or arbitrage of market inefficiencies. Key types include futures, options, swaps, and forward contracts. While more complex and risky than stocks and bonds, derivatives offer additional flexibility and leverage, subject to risks such as counterparty risk, liquidity risk, and operational risk. 5. Factors influencing financial markets asterisk. Understanding the dynamics of financial markets involves analyzing various factors that shape their behavior. These factors can be broadly categorized into economic, political, and psychological influences, providing insights into market trends and aiding in informed decision-making by investors and traders. Some key factors include interest rates, inflation, government policies, geopolitical events, investor sentiment, and market expectations, all interacting with each other and having short and long-term effects on financial markets. By considering these influences, market participants can better navigate the complexities of the financial landscape. 6. Analyzing market trends and patterns. One of the most important skills for any investor or trader is the ability to analyze market trends and patterns. Market trends refer to the general direction of price movement of an asset or market over time. Market patterns are specific shapes or forms that price action creates on a chart. By analyzing market trends and patterns, you can identify optimal entry and exit points for your trades, as well as the potential future direction of the market. In this section, we will discuss some of the most common and useful methods of analyzing market trends and patterns, such as 1. Trend lines and channels. Trend lines are straight lines that connect highs or lows of price action, showing the direction and strength of the trend. Channels are parallel lines that contain price action within a trend. Trend lines and channels can help you determine support and resistance levels, as well as breakout and trend reversal points. 2. Moving averages. Moving averages are indicators that smooth out price action by calculating the average price of an asset over a specific period of time. Moving averages can help you identify the direction and momentum of the trend, as well as dynamic support and resistance levels. There are different types of moving averages, such as simple, exponential, weighted, and smoothed, each with its own advantages and disadvantages. 3. Chart patterns. Chart patterns are specific shapes or forms that price action creates on a chart, indicating trend continuation or reversal. Chart patterns can be classified into two main categories: reversal patterns and continuation patterns. Reversal patterns signal that the current trend is likely to change direction, such as head and shoulders, double tops and bottoms, and wedges. Continuation patterns signal that the current trend is likely to resume after a brief pause, such as flags, pennants, and triangles. 4. Technical indicators. Technical indicators are mathematical calculations that use price and volume data of an asset to generate signals or information about market conditions. Technical indicators can help you measure the strength, direction, volatility, and momentum of the trend, as well as overbought and oversold levels. There are hundreds of technical indicators, each with its own formula and interpretation, such as trend indicators, momentum indicators, volatility indicators, and volume indicators. By using these methods of analyzing market trends and patterns, you can gain a better understanding of financial markets and make more informed and profitable decisions. However, you should also be aware of the limitations and challenges of these methods, such as market trends and patterns are not always clear or consistent and can change or break at any time. Market trends and patterns are not the same for different time periods, assets, or markets and can vary depending on context and perspective. Market trends and patterns are not the only factors that affect the price movement of an asset or market and can be influenced by external events, such as news, fundamentals, sentiment, and psychology. Market trends and patterns are not a guarantee of future performance and can be affected by random noise, false signals, and human errors. Therefore, you should always use market trends and patterns as a guide, not as a rule, and combine them with other tools and methods of analysis, such as fundamental analysis, risk management, and trading psychology. By doing so, you can increase your chances of success and achieve your financial goals. 7. Risk management in financial markets. Risk management is a crucial aspect of investing and trading in financial markets. It involves identifying, assessing, and mitigating potential losses that may arise from various sources of uncertainty, such as market volatility, liquidity, leverage, credit, operational, and regulatory risks. Risk management can help investors and traders optimize their returns, protect their capital, and avoid catastrophic losses. In this section, we will explore some of the key concepts and strategies of risk management in financial markets, such as 1. Risk-reward ratio. This is a measure of how much return an investor or trader expects to gain for each unit of risk they take. A higher risk-reward ratio means that the potential reward is greater than the potential risk. For example, if an investor expects to earn $100 by risking $50, their risk-reward ratio is 2 to 1. A common rule of thumb is to look for a risk-reward ratio of at least 1.5 to 1 or higher, depending on risk tolerance and investor or trader objectives. 2. Stop-loss and take-profit orders. These are orders that automatically close a position when the price reaches a predetermined level, either to limit losses or lock in profits. Stop-loss orders can help investors and traders reduce their losses and avoid holding on to losing positions for too long. Take-profit orders can help investors and traders secure their profits and avoid giving back their gains to the market. For example, if an investor buys a stock at $10 and sets a stop-loss order at $9 and a take-profit order at $12, they will exit the position if the price falls to $9 or rises to $12, regardless of their emotions or market conditions. 3. Position sizing and diversification. These are techniques that help investors and traders allocate their capital across different assets, sectors, markets, and strategies, based on their risk appetite and objectives. Position sizing refers to the amount of money invested or traded in a single position relative to the total portfolio value. Diversification refers to the degree of variety and balance among a portfolio's positions. Position sizing and diversification can help investors and traders reduce their exposure to specific risks, improve their performance, and smooth out their returns. For example, if an investor has a $100,000 portfolio and wants to invest in 10 different stocks, they can use a position sizing method, such as the equal weighting method, which allocates $10,000 to each stock, regardless of its price or market capitalization. Alternatively, they can use a diversification method, such as the sectoral method, which assigns $10,000 to each of the 10 major sectors of the economy, such as technology, healthcare, energy, and so on. 8. Strategies for navigating financial markets. Navigating financial markets can be a challenging task for anyone, especially in times of uncertainty and volatility. Financial markets are complex systems that involve many factors, such as economic conditions, political events, investor sentiment, and technological innovations. To succeed in financial markets, it is necessary to have a clear understanding of market dynamics, risks and opportunities, and strategies and tools that can help you achieve your goals. In this section, we will explore some of the strategies that can help investors and traders navigate financial markets effectively. We will cover the following topics. 1. Market analysis. How to analyze market trends, patterns, and indicators using different methods, such as fundamental analysis, technical analysis, and sentiment analysis. We will also discuss how to use market data and information. Sources to make informed decisions. 2. Risk management. How to measure and manage your portfolio's risk exposure using techniques such as diversification, hedging, stop-loss orders, and risk-reward ratios. We will also discuss how to deal with market uncertainty and volatility and how to avoid common pitfalls and biases. 3. Trading psychology. How to develop and maintain a positive and disciplined mindset and how to overcome the emotional and behavioral challenges that can affect your performance in financial markets. We will also discuss how to set realistic and achievable goals and how to monitor and evaluate your progress. 4. Trading systems, how to design and implement a trading system that suits your personality, style, and goals, using various tools and platforms such as trading software, algorithms, and automation. We will also discuss how to test and optimize your trading system and how to adapt to changes in market conditions. 9. Conclusion and additional resources. Financial markets are complex and dynamic systems that impact the lives of billions of people around the world. They offer opportunities for investors, entrepreneurs, savers, borrowers, and consumers to achieve their financial goals and contribute to economic growth and the development of their countries. However, they also present significant risks and challenges that require careful analysis, regulation, and management. In this blog, we explored some of the key concepts, functions, types, and participants in financial markets, as well as some of the current trends and issues shaping their evolution and performance. We hope this blog has provided you with a useful overview and a solid foundation for further learning and research on this fascinating and important topic. In this final section, we will suggest some additional resources you can use to deepen your knowledge and understanding of financial markets. 1. Books. There are many books that cover various aspects of financial markets, from historical and theoretical perspectives to practical and empirical ones. Some recommended books include The Ascent of Money, A Financial History of the World by Neil Ferguson. This book traces the origins and development of money and finance from ancient times to the present day and examines how they have influenced the course of human history and civilization. The Intelligent Investor, the definitive book on value investing by Benjamin Graham. This book is considered the Bible of value investing, a strategy that focuses on buying undervalued stocks and holding them for the long term. It offers timeless principles and advice for investors of all levels and backgrounds. The Big Short, Inside the Doomsday Machine by Michael Lewis. This book tells the story of the 2008 financial crisis and how some outsiders and mavericks predicted and profited from the collapse of the subprime mortgage market and the subsequent credit crisis. 2. Online courses. There are many online courses that offer interactive and engaging learning experiences on financial markets, from introductory and general ones to advanced and specialized ones. Some popular online courses include Financial Markets by Yale University on Coursera. This course provides an overview of the ideas, methods, and institutions that shape financial markets and covers topics such as risk, efficiency, behavior, regulation, and innovation. Introduction to Finance and Accounting by the University of Pennsylvania on edX. This course introduces the fundamentals of finance and accounting and covers topics such as financial statements, ratios, valuation, capital budgeting, and working capital management. Machine Learning for Trading by the Georgia Institute of Technology on Udacity. This course teaches how to apply machine learning techniques to analyze and trade financial data and covers topics such as market mechanics, portfolio optimization, reinforcement learning, and high-frequency trading. 3. Podcasts. There are many podcasts that offer insightful and entertaining discussions and interviews about financial markets, from news and analysis to stories and opinions. Some popular podcasts include Planet Money by NPR. This podcast explains economics and financial markets in a fun and accessible way and covers topics such as inflation, cryptocurrencies, trade wars, and bailouts. The Investors Podcast by Preston Pysh and Stig Brodersen. This podcast features interviews with some of the most successful and influential investors and entrepreneurs and covers topics such as value investing, growth investing, passive investing, and personal finance. Freakonomics Radio by Stephen J. Dubner and Stephen D. Levitt. This podcast explores the hidden side of financial markets and economics and covers topics such as behavioral economics, incentives, market failures, and rationality. If you enjoyed this content and want to stay updated on more information and insights about financial markets, don't forget to subscribe to our channel and like this video. Stay tuned so you don't miss any of our upcoming videos full of tips, analyses, and much more. Thanks for watching and see you next time.